25 days. That's how long until the most critical date in the silver market this decade. February 27th, first notice day for March COMEX contracts. On that day, holders of 109 million ounces worth of silver futures will face a single question. Do I want cash or do I want my metal? And here's the truth nobody on Wall Street is saying out loud. COMEX vaults don't have enough silver to meet that demand. Registered inventory, the physical silver actually available for delivery, has collapsed by more than 70% since 2020. In just the first 7 days of January, 33 million ounces disappeared from the vaults. That's 26% of all registered silver, gone in 1 week. And perhaps the most stunning detail of all, 99% of those deliveries came from a single institution, JPMorgan. Last Friday, silver crashed 30% in its worst single day since March 1980. Everyone talked about Trump's Fed nomination, Chinese speculators dumping their positions, margin hikes from the CME. All true. But the real question is one that almost nobody is asking. Why now? Why exactly 1 month before March delivery? Why did the CME raise margins after the crash instead of before it? Because this wasn't a random market correction. This wasn't even really about Kevin Warsh. This was a calculated move executed ahead of the coming delivery crisis. And if enough traders stand for physical delivery in March, if they demand real metal instead of paper promises, COMEX will face only two choices: deliver silver it doesn't have, or switch to cash settlement and admit the entire system is a fiction. This isn't conspiracy theory. This is mathematics supported by CME's own published data, daily vault reports, and delivery statistics that anyone can access. And once you understand this math, you'll see why last week's crash was inevitable, and why the next 25 days could fundamentally change how the world prices silver. To understand how we got here, we first need to understand how COMEX actually works, and how different that is from how it was supposed to work. COMEX is part of the Chicago Mercantile Exchange Group and serves as the world's largest silver futures market. In theory, this market was designed as a hedging mechanism to help producers and consumers manage price risk. A mining company can sell silver it will extract 6 months from now at today's price, locking in a guarantee. A solar panel manufacturer can fix the cost of future silver needs. A jewelry maker can protect against price spikes. Elegant system serves a real economic purpose. One problem, it doesn't work like that anymore. CME's own data shows this uncomfortable reality. Less than 2% of precious metals. Futures contracts result in physical delivery. The remaining 98% either settle in cash or roll into the next contract period. This allows the system to function with relatively modest physical inventory compared to the mountain of outstanding paper obligations. In theory, no problem. The futures market was never meant to be a delivery mechanism for everyone, just a price discovery tool. But in practice, this creates a massive and growing gap between paper silver and physical silver. Some estimates put this ratio at 356 to 1 before the crash. Let that sink in. For every single ounce of real silver sitting in a registered vault, 356 ounces of paper silver were trading on exchanges. That's not a market, that's a confidence game. Now let's look at the vault system itself, because this is where the cracks are showing. COMEX-approved depositories hold two categories of silver: registered and eligible. Registered is silver ready for delivery, tagged with a warrant, available to be delivered against futures contracts at any moment. Eligible meets the quality standards, but isn't currently designated for delivery. It's essentially in storage, waiting. The critical difference: only registered silver is truly deliverable. And that registered category has collapsed by more than 70% since 2020. In absolute terms, we're talking about going from over 400 million ounces to around 127 million at the start of January. If this information is valuable to you, if understanding this mechanism is changing how you see the silver market, hit the like button and subscribe, because what's coming next is where things get truly insane. In December 2025, within just 4 trading days, more than 60% of all registered silver was claimed for physical delivery. 4 days, and the system nearly broke. In the first week of December 2025, something strange started happening in the COMEX silver market. Delivery notices spiked in ways that hadn't been seen in decades. In a single day, 7,330 contracts, representing 36 million ounces of silver, demanded physical delivery. That was roughly 30% of COMEX's entire free-floating silver supply in one trading session. And that was just the beginning. Within 4 trading days, a total of 47 million ounces, more than 60% of registered inventory, was claimed for delivery. Analysts and market observers immediately called it a vault drain emergency. They were right to be alarmed. But the truly strange thing wasn't the delivery demands themselves. It was the behavior of traders in the weeks that followed. In early January, CME data revealed an unusual pattern that sent chills through anyone paying attention. March contracts were rolling backward. Normally, traders move from near-term contracts to further dated ones, March to May, May to July. This is called rolling forward, and it is how most futures traders manage their positions without ever taking delivery. But here, the opposite was happening. Traders were selling March contracts and buying January and February instead. Why would anyone do this? Because they didn't want to wait until March. They wanted their physical silver immediately. Right now, not in 2 months. Silvertrade's granular analysis of open interest data revealed the scale. In 1 week, approximately 850,000 ounces worth of futures contracts rolled backward from March into January and February delivery months. Another 1.7 million ounces followed the next week. This is the market screaming that it doesn't trust the March delivery process. And as this demand accelerated, one institution took center stage. In the first week of January, 99% of all silver deliveries were issued by JPMorgan, meaning JPMorgan was the delivering party. Nearly all 8 million ounces came from a single bank's vaults. Now let's examine CME Rule 802. This obscure provision grants the CME board authority to change margin requirements at any time without notice. On January 7th, with delivery demands hitting records and vault inventories draining, they used that authority. Silver margins were hiked 47% to $32,500 per contract in a single week. The CME's official explanation was standard boilerplate, a response to market volatility to ensure adequate collateral coverage. But look at the timing. Delivery demands spiking, vaults draining, physical premiums widening, and right at that moment, margins get raised. Who benefits from this? Small traders and investors wanting physical metal, or large banks sitting on massive short positions who need those delivery demands to disappear? Here's the critical point that most mainstream analysis completely misses. CME is not a government agency. It's not a neutral market regulator. It's a for-profit corporation traded on the NASDAQ stock exchange. Ticker symbol CME. Market cap around $80 billion. And do you know who its clearing members are? The institutions that backstop the entire system? JPMorgan, Goldman Sachs, Bank of America, and other major banks. The same banks that, according to CFTC commitment of traders data, are currently sitting on concentrated short positions in silver. If one of these banks defaults on its obligations, CME is legally liable. That's why CME's risk management functions more like a bank protection program. The referee isn't just watching the game. He's actively protecting the team that's losing. And there's another detail that should concern anyone who believes these markets reflect reality. At the bottom of every CME Daily Vault report, there's a small legal disclaimer that most people scroll right past. It reads, "This report is produced for information purposes only." Do you know what that phrase means in legal terms? It means these vault reports are not audited by an independent third party. Nobody is going into those vaults to match physical bars against electronic records. Nobody is conducting purity tests. Nobody is doing physical counts. The numbers you see are whatever the vault operators, primarily JPMorgan, tell CME to publish. CME added this disclaimer shortly after acquiring COMEX in 2008. Why did they add it? Because they have concerns about accountability. But instead of implementing actual accountability measures, independent audits, random inspections, third-party verification, they chose a legal shield that protects them if the numbers turn out to be wrong. Now here's a question I want you to genuinely think about. If COMEX shows a price of $78 while physical silver in Shanghai changes hands at $85, which price is real? Even during the worst of Friday's crash, Shanghai physical premiums held at $5 to $8 above the futures price. Reports emerged of physical silver in Tokyo and Dubai trading at 80% premiums, transactions clearing at up to $130 per ounce. While the paper price was collapsing, the physical market barely flinched. This divergence isn't new, but it's accelerating. And it tells us something profound about which market actually reflects supply and demand for real metal. Drop your thoughts in the comments because this might be the most critical question of 2026. Does the COMEX price reflect reality, or is it a fiction maintained by leverage, margin manipulation, and forced liquidation? Whatever your answer, March will give us a definitive one. So what will the next 25 days bring? Let's start with what's certain. On February 27th, first notice day for March contracts begins. From that moment forward, contract holders can officially demand physical delivery instead of cash settlement. Current open interest for the March contract stands around 109 million ounces, and that number represents 90% of all registered inventory in COMEX vaults. If even a significant fraction of these contracts stand for delivery, the math simply doesn't work. There isn't enough metal in the vaults to satisfy the claims. COMEX's options at that point become severely limited. First option, convert eligible silver to registered. But that's just an accounting trick. It doesn't create physical silver, just changes a label in a database, and there's no guarantee that eligible silver owners want their metal redesignated. Second option, extend delivery timelines significantly. This is already happening at the LBMA in London, where delivery times have stretched from the typical few days to several weeks during high demand periods. Third option, switch to widespread cash settlement. This would mean openly admitting that the paper price has completely disconnected from physical reality, essentially declaring that COMEX is no longer a delivery market but a cash betting market. And fourth option, raise margins even higher to crush physical delivery demand before it materializes. We already saw this playbook executed last Friday. There are major uncertainties too. How many traders will actually stand for delivery versus rolling forward or settling in cash? Large industrial users, the solar panel manufacturers, semiconductor companies, electric vehicle battery makers who actually need silver to build products, are increasingly bypassing COMEX entirely. They're making direct deals with mining companies, securing supply through prepayment arrangements and long-term offtake agreements. Samsung finalized a deal last year to restart a silver mine in Mexico through a subsidiary. Tesla has been locking up physical supply through similar mechanisms. These companies don't trust the paper price. They need real metal to keep their factories running, and they've concluded that the exchange system can no longer reliably deliver it. Let's return to where we started. 25 days. In that window, either COMEX will handle March deliveries smoothly and prove the system still functions as advertised, or we'll witness the first large-scale silver delivery crisis in modern market history. In either scenario, one thing won't change. 5 consecutive years of structural supply deficits, China's strategic export restrictions that went into effect January 1st, the unstoppable rise in industrial demand from every major technology trend of the next decade. These fundamentals don't disappear with a margin hike, a price crash, or Federal Reserve nomination. The system was designed to stay hidden from you. Unaudited vault reports that carry legal disclaimers, margin rules that can be changed without notice to protect clearing members, an exchange that profits from the same banks it's supposed to regulate, but the data is there for anyone willing to look. The delivery reports are published daily, the vault inventories update every afternoon. And now you understand what those numbers actually mean. In 25 days, we'll all see together how valuable this knowledge really is.